It's not just people who have their ISAs with free trade. Okay, well, that's the big stories out of the way this week. Should we talk about banks for a bit?
Yeah, something happened there, Steve. What have you got on it?
Well, the stock market's moving around a little bit, and it's not just because Warren Buffett's been buying more Occidental shares. He has, though. I saw that. Michael Burry said everything's fine. We'll come to that as well in a moment. But there's a banking crisis on, in case anyone didn't know. That's why bank shares have been falling all over the place. There's been a bank failure in the US, or there's been a couple of them actually, but the most notable one was a company called Silicon Valley Bank, which provided banking service to basically quite a lot of tech startups. And here's sort of roughly what happened. Tech startups, as we've talked about on this show, tend to not be terribly profitable ventures, and that means that rising interest rates makes it harder and harder for them to get funding. Debt isn't available so easily, and they can't afford to pay back the debt anyway. So as a result, they need cash, they want to get it out the damn bank, which is fine as long as they don't all want to do it at the same time, and at a time when the bank has stuck it into bonds that are now priced and marked to market at less than what they initially paid for them at, because that means the bank doesn't necessarily have it anymore. And then once you start getting rumours that the bank might not have your money as a deposit anymore, or might not have everybody's money that they deposited anymore, you will hurry up and get it out pretty damn quick before they run out of money full stop. And that's pretty much what happened at Silicon Valley Bank. The Fed has jumped in to backstop this a bit, but this is, and it's basically made depositors whole within the insured limit, which I think is about $250,000 over in the US. But pretty much everyone who was attempting to get their money out of Silicon Valley Bank has, I think, managed to do it, and in pretty efficient and quick order as well. Nonetheless, the failure of a bank is a fairly contagious fear, and it's causing bank shares to fall all over the place. This is kind of unlike other crises in an interesting way. So if you think, oh good, another bank crisis like the 2008 one, this one ain't quite like that. This isn't the product of Silicon Valley Bank doing a lot of dumb stuff and lending money to people who clearly couldn't pay it back to them and then finding, oh no, we can't get it back again. This is them sticking it in stuff that banks are supposed to stick it in, basically kind of bonds and T-bills and mortgage-backed securities and those sorts of things which are insured. But the price of them went down and suddenly everyone wanted their money out at the same time. As we'll come back to in a little bit, where there's trouble in the banking sector, there's usually Credit Suisse. But, Steve, any thoughts on Silicon Valley?
Yeah, really, I think they're getting a lot of flack, and I think maybe potentially deservedly so. I think they went 9 months without a risk manager previous to this, which is kind of like, it kind of smacks of, kind of smacks of the problems that they face. But this wasn't, at the time, probably didn't feel like the worst move they've ever made. So they got this massive influx of deposits because money was free and money was flowing, and all of the VC-backed startup companies were getting VC funding, big amounts, huge SPAC money coming in, going to pretty much anything, and all of this was getting deposited at the Silicon Valley Bank. More deposits than they've ever had. And they'd had this massive influx of cash, didn't know what to do with it, so did what a good bank should do and started to buy some treasuries and keep it in safe mortgage-backed securities, which are obviously insured by the government as well. So these are good things that they shouldn't lose money on. The issue being that VC since tightened and rates have since increased. So if you had a bond that was paying 1%, all of a sudden you've got bonds paying 6%, and you need to get rid of these bonds because cash burn has continued at the Silicon Valley companies. They need the cash to basically allow this cash burn to continue. They've got to sell 1% bonds to people who are used to buying 6%. Well, you've got to sell them at a fraction of the price, a few cents on the dollar probably, and that's what they had to do. Essentially, fire sale off their assets to be able to service their clients. Unfortunately, when you announce that and then try and announce an equity raise, it makes you look like you're in serious trouble, and that was the case. With Silicon Valley Bank, they collapsed shortly afterwards. The equity raise was just laughed off the park because why would you? And and that was it, really. That's it. They've disappeared. The UK arm has gone to HSBC, bought for £1. Steve and I think, on the face of it, we've not dug too deep into that. That looks like one of the best deals that anybody's managed to get out of this collapse so far. But yes, it's been an interesting kind of couple of days, and for people, there was a lot of people on Twitter saying like, "This is it, this is the end," and Kiyosaki must have been like milking himself silly because he's been trying to claim this is going to happen. But actually, this looks it looks fairly contained. What's happened here has been a bank run on a very poorly diversified bank. All the other banks have had smaller bank runs on them, but theirs are more due to fear than actual massive systemic issues, which is what Silicon Valley had. I'm ignoring Silvergate and Signature Bank here because I think they're a completely different kind of problem. But I don't know, Steve. I thought this kind of, well, and Burry agreed kind of, that this has been sort of nipped in the bud.
Yeah, 3 thoughts then. So on the HSBC thing, it looks to you and me like they have acquired a bank that was solvent, that was profitable, but that had liquidity issues. And acquiring anything that's solvent and profitable for £1 is a hell of a buy, from what I can tell. I haven't dug too deeply into this either, but a massively well-capitalised thing like HSBC, which I assume it is, and I would guess that HSBC have had a look and said, look, do we have enough liquidity around to fend off a run on this part of Silicon Valley's bank? Yes. In that case, let's take it, and if we take it for kind of anything, we'll at least pick up. The issue for Silicon Valley's bank was that it was fine if it was allowed to let its bonds run to maturity, but it couldn't let its bonds run to maturity with people wanting their money out. It had to sell the bonds to give them their money back, and eventually they ran out of it. If HSBC can just grab the bonds and keep them to maturity, using its liquidity of its own to fend off a run on that bank, they're going to be in great shape from this. This is, I think, going to be a terrific deal. So encouraging stuff there, at least at first sight. Neither of us has dug very deeply on this. To a point that you mentioned before, second thing for me here, you kind of hinted that you thought the bank might have been kind of blameworthy, and you said poorly diversified here. There's a real question, and I've gone backwards and forwards on this, as to whether I think this is a massive management failure at SVB. And I'm, at the moment, on the side that says, yes, it was. So the case for thinking it wasn't is that they, invested in the right stuff. They bought bonds. Bonds are traditionally thought to be pretty low risk. They bought mortgage-backed securities, which, if they're government compliant, then they are insured. Look, these are things, and it's not the case that those things went bad in the sense that anyone defaulted or anything. But to your point about diversification, that bank should have known that, look, we have a lot of tech startups here. Rising interest rates are going to smack us 2 ways. It's going to make bond prices go down. That's not complicated. And it's going to mean that these companies need cash from somewhere, and it's probably going to be their own cash. That I think if you run a bank that is catering to tech startups, you should know that about them. And you should know that you are rising interest rates, and it's not been that hard to see rising interest rates coming, Steve. We've had plenty of time to sort of see this from kind of years out here. I think if you're Silicon Valley Bank, no one expects a bank run. I'm not saying you have to necessarily plan one, but you are going to be hit from both sides in the event of rising interest rates if you're going to run this kind of business.
Yeah, and I think that's probably comes with the territory of not having a risk officer. They keep saying, like, probably at the meetings, they're like, does anybody foresee any risks? And they'll be like looking around going, nope. And then the risk officer chair has obviously not been filled for the last 9 months, so they've probably not spotted it. But yeah, that's entirely my point, is that when I say they're not diversified, it's not that they're not doing all the things, in terms of looking after deposits that a bank should do. It's that their clients aren't diversified. So when you've got people who are predominantly not making money, are burning cash, who are constantly going to be requesting cash from the bank, it seems stupid not to have quite a large pool of liquidity available for any kind of situation where that would happen. Now, they would argue at the time, we didn't know bonds were going to go up to 6%. Well, you probably should have done, and that's the issue that essentially they're facing. So, I don't know, Steve. I emphasize. I sympathise with them a little bit in that I think they were probably a little bit drunk on sort of the last sort of 15 years of a very, very steady growing market for them, where everybody kept getting more money. You could click your fingers and get VC money, and then it has been like the tap has turned off, and they just haven't adapted, and that's really where they failed.
Yeah, so thinking about risk then for the moment, I mean, bank shares are falling all over the place, and you said you think that's mainly fear rather than, I guess, what we might call danger in any deep way. And I think you're right here, but I've been reading some things that kind of trouble me a little bit in the sort of thinking about the risks and the dangers here. So I'll just give you my thoughts for a moment here. Here are two lines of response to say, look, you're going to be fine buying Lloyd's or Bank of America or JP Morgan or Barclays, or you choose your favourite kind of biggish bank here, for one of two reasons people have been saying, I think. Number one is that, look, these are big, important banks. Governments just simply, or central banks, or generally authorities, just cannot allow them to fail. It would be disastrous if even one of them was allowed to go under and customers lost their deposits. I think that's a lousy reason here, because it's one thing to think that, yes, they can't allow consumer deposits to go missing, but they don't have to save the bank in order to do that. I mean, that's pretty much what's happened at Silicon Valley Bank. I think the Fed, the FDIC, and Treasury in the States has made whole the depositors. The banks themselves and the shareholders have, as far as I'm aware, been pretty much wiped out. So if you're a shareholder in one of these, there's no sign, as far as I can tell, that the size of the bank means anyone is going to come and save you, though they may well save the bank's customers out of fear of failure. Another one is that these banks are better regulated since 2008. I don't buy that argument either. If I look at their kind of CET1 ratios, which basically covers their kind of liquidity as a function of their risk-weighted assets, I don't think they'd survive a bank run. I think that most of what they have covered here is to do on the loans side, to making sure that their debts aren't all going to go bad together. That was what the problem was back in 2008. That's not the problem now. The problem is liquidity. So I don't think that regulation is something to hide behind either here. Here's what I think this comes down to, basically. And I do think that I agree with you that it's just a matter of fear, and I don't think there's terrific risk in the banks at the moment. This may be famous last words. This might be like a Kramer Bear Stearns moment.
Just about to say that, yeah, this is our Bear Stearns moment.
Yeah.
Get ready to be cancelled, Steve.
Okay. Look, I think that the Federal Reserve and the FDIC and so on, by being decisive with Silicon Valley Bank and making depositors whole, are going to stop a massive run on the banks. And I think the only way to stop a crisis here is to stop a run on the banks. I don't think the banks can survive it, and I don't think that shareholders will survive it if the banks don't. But what that means is they have to kind of convince depositors, you will be made whole if you basically you will get your money back. By the way, I keep using that expression. You will get your money back if your bank fails. And what that means is you do not need to go and pull your money right now, because it will still be there for you, even if you're the last person left in the damn bank. We'll give it back to you. And in doing that, you take away the reason for wanting to pull the deposits, and not for a startup tech company that needs them to pay the bills or something, but for anyone who's just worried that, look, if I leave this another 2 weeks, my money ain't going to be there because the bank will be gone. That concern goes away, basically. And I think that's the risk, and I think that's probably been fended off fairly effectively for the moment by some fairly decisive central action. So from what I can tell, in terms of the big banks, I had a kind of hunch of, well, look, anyone who's making a run on small US regional or smaller US regional banks isn't doing it so they can stuff it under their mattress at home. They're going to go and take it somewhere else, and what they're going to do is try and stick it in the safest place they can find, which is probably a big structurally important bank somehow. And based on what I've been hearing just recently, I'm right about that. JP Morgan and Bank of America are seeing deposits going up. I would be surprised if it's not broadly similar in this country with something like Lloyd's and Barclays and NatWest and HSBC and Santander and so on and so forth. So it feels to me like, while they're quietly sitting there saying, what liquidity crisis? No liquidity crisis at JP Morgan. We got plenty of liquidity. No one's worried about us going under. This is doing wonders for their brand.
The irony of it all, Steve, is that First Republic, which is one of the banks that was rumoured to be in a little bit of trouble. They had a deposit outflow from the run on the bank. That money got deposited at Morgan Stanley and JP Morgan, who have since deposited it back into First Republic to help them out with their liquidity. So essentially they have become beholden to JP Morgan. I assume that money is not being deposited just for the goodness of their own hearts. There's going to be a little fee attached to that, isn't there, to keep JP Morgan and Morgan Stanley happy. But there you go. So yeah, doesn't really matter where you put your money. The big boys always end up doing what they want with it anyway. So
yep, one big investing lesson I guess from me, and it's the same lesson that we always talk about. It just shows up in different places, which is whenever you invest your money, whether you're a bank or whether you're me or whether you're Casper or whether you're just an ordinary someone listening to this show, don't invest money that you might need to pay your immediate expenses, because if you stick it into something, I don't really care what, whether it's a bond or some equities or whatever, you might find yourself in trouble when the price of that thing has gone down, and then you'll have to sell the thing in order to pay off it, and you'll be selling it low. And I'm not saying it will bankrupt you, but the point is, if you get yourself into a position where you have to sell investments in order to make ends meet, that will generally be at a time when you don't want to be selling them. And that's as true if you're a bank as it is if you are making a podcast about a bank.